Hey everyone, in this video we're going to look at the exercises here for chapter 3 and go through some of the adjusting entries and closing entries, etc. And also the classified balance sheet. So um, as always, I think everyone's pretty familiar with the drop downs and selections here. I'm going to skip over to this first tab and let you all um, go through and analyze the drop down questions here. They're pretty basic, maybe just a couple little comments here in case anybody wants a little refresher on the things that we talked about. So remember, normal balance when it comes to debits and credits is the side either left or right. Remember, debit or credit is the side that the balance increases on. So here, if we're saying cash, remember that's an asset. So it's going to have a debit increase and therefore a debit normal balance as well. It's going to go on our balance sheet. And then cash is a current asset, so that's going to be listed there. And yeah, not too tricky, I don't think, otherwise for anything. One comment maybe I will just make is when you're looking at some of the liabilities, long-term liabilities like notes payable here, there can be it could either be short-term or long-term depending on the end date of the liability. And so you need to, if something is due within 12 months of the date of the balance sheet here we're looking at, so anytime the portion of a payment or if the full payment for this note payable was due in 2010, for example, we're looking at this, it says 12/31/2009. So if it was due within the 12 months subsequent to the period that we are assuming as a balance sheet date, then it's going to be a current liability. But since this is so far out beyond the end of the following 12 months, then, not the income statement, it's going to be a long-term liability or non-current essentially. So you can on a balance sheet as well, you can have a portion of the note payable. Maybe there's a current portion, and that would be the principal payment due within the next 12 months. And then the long-term portion would be the full residual balance of the note payable that would be due beyond those 12 months. So you could have both a current portion, a non-long-term portion, and then a long-term portion for a given note, just depending on kind of the payment structure and when it's due. So to figure that out, remember, look at your ending balance, what is balance sheet date we're looking at, and then look at the date that the liability is due. Okay, again, I'll let you all list out the steps here. This is just going to your notes or the book or other reference materials and notes, etc., making right selections there. Okay, for our problem number 4, we're going to be looking at closing entries here. And so for our closing entries, we're going to be using the income summary. Remember, that's kind of this temporary vessel account, if you will, where amounts close into the income summary, and then we take those amounts out of the income summary and put them against retained earnings, essentially. So in essence, what we're doing with the income summary is basically it's what's on the income statement. It's revenues and expenses, essentially. So let's walk through that, and it'll make a little more sense once we kind of get into it. And so remember, when we're doing our closing entries, we're going to be recording a balance that is essentially on the opposite side of the normal balance to zero out these accounts. So if we have our T account, and we could, I'm just envisioning this in T account form. So let's say we have service revenue. Revenue has a credit normal balance. So if we were to look at a T account with the service revenue, it would be on the right side of that T account, the credit side, right? And so to close that, we want to book a debit for the same amount. And that is, previously we had a credit balance of 810. Now we do this closing entry, and let's just do that real quick, to for the amount that was the credit balance. So it's originally a credit balance, but then we debit it for the full amount, which in essence makes that account balance and service revenue go to zero. And then, as I said, we're going to close that into our income summary. And it's just going to be the same amount there. So that's the revenue portion. And as I said, the income summary here for these first two pieces is all about the revenues and expenses, basically, right? So first we handle our revenues, and then in expenses you can see we have advertising expense, prepaid rent, rent expense, and wage expense, and that looks like everything there. And so remember, expenses have a debit normal balance. So if we were to look at these in T account form again, the advertising expense balance of $45 would be on the right side of the T account, the left side of the T account, the debit side, debit normal balance. So what we're going to be doing is we are going to credit all of the expenses to essentially make them go to zero again. So close those out with these are closing entries. So we're closing those to zero, and we are going to be putting those balances as a total into our income summary, essentially. So let's take a quick look at what that looks like. So again, we're going to credit all of our expense accounts for the exact amounts that they would have had, as a debit balance before we do the closing. So there we go. And then again, we're going to use the income summary. This time we're going to debit it, because when we're closing our expense accounts, we're crediting as the opposite of the revenue, where we credited the income summary. Okay, so we just add all that up. And then this question here asks how much was net income for the period, and what we can basically see. Let's do this separate second part real quick. So what we're going to do is close out the income summary now to the retained earnings account. And the way I do this that I find helpful to easily identify, I suppose, whether we're going to credit or debit the income summary, because it does make a difference whether you have net income or a net loss, which way you're going to debit or credit this thing to close it, whether it has a credit or a debit balance after you take into account both of these transactions. I always look and see, okay, we can see we have a credit balance of $810 for income summary, and we only have a $450 debit. And what we want to do is the debits and credits want to be the same for the income summary to close it. So here we can say we're going to need to put a debit in, because the smaller amount, is on the debit side, and we want to equal up to the credit balance, basically. So to figure out what that balance is, we can just take the difference between those two, and that's to our income summary. And so now if you took 360 plus 450, that would equal what we had on the credit side. So that's just a little trick that I use to make it easier to see whether you're going to be crediting or debiting the income summary to close it, especially when you're looking at it in a journal entry format. In a T account, you can sort of see which side is bigger, a little easier, but when you're looking at journal entries, I find that helpful. Okay, so that's all the income summary activity, and now we can see net income is 360. That's kind of what we're doing, is we're saying revenues minus all of our expenses is 360. And then we're closing that into the retained earnings account. So we're increasing retained earnings. Remember that on dead circle, the retained earnings is on the credit side as an increase. And so what we've done, in essence, by doing all this journal entries, is we've increased our retained earnings by the amount of net income. And we've closed out to zero all those income and expense accounts. And now they're zero. So when we start the next month, we can start putting more amounts into there, fresh from a beginning of zero. There's never any opening balance, remember, in income, revenue or expense accounts, and this is the process to zero those out so that they start out zero every month with no opening balance. Okay, so the last thing we need to do is close out our dividends account. So remember that a dividends account has same as a expense, it has a debit normal balance. So we want to credit that the dividends to make it go away, essentially to close it. So if we were again to look at a T account of dividends, it would be on the debit side, the left side. So we're going to credit that on the right side to get it to go to zero. And our account that we use for closing that into, again, is retained earnings. And how much did retained earnings change over the period? So we know it went up by 360. And then dividends is a decrease to retained earnings. So we could just subtract that out to get our answer there of 270 in this version of my homework. So, okay, let's go to the next problem here. So we've got a number of different adjusting entries to record. I'm going to have an Excel spreadsheet off to the side here that is just kind of helpful for doing some of these. So if you have a dual monitor and you can kind of have Excel or at least your calculator off to the side, very helpful. Because some of these, for depreciation, et cetera, you need to do some calculations. So, all right, on 11/1, we purchased $450 of office supplies with this check number. Okay, so what we're going to say here is, we paid with a check, which, remember, if we ever say paid with check, just keep in mind that's checks are the same as cash from an accounting perspective, essentially. And so our cash goes down, and our office supplies, if I can find the account there, I guess supplies goes up $450. So our asset of supplies increases and our asset of cash decreases. And we could just put anything in here. I'll say purchase supplies. And I'll say number 978. In the real world, right, if we're cutting a check, this tells us this is the explanation. But in the real world, we might want to put that explanation. So if we ever went back, we'd say, okay, this is the check number we used. So, okay, now record the adjusting entry if $90 of supplies remain at the end of November. So the end of the month, essentially. So we bought $450 of supplies at the beginning. Now we go look and do an inventory count. We say, oh, there's only $90 left. So what we can ascertain then, step one, let's do the adjustment, right? So to adjust the balance from 450 to 90, which is accurate now, we want to take, the difference between those. So that's 360. So we're crediting our asset account of supplies by 360 to reduce it down to an ending balance of 90, which is what we found when we did our count, essentially, right? And then since the supplies are gone, they've been used up, we're going to want to record an expense to represent the fact that those are gone. And debits need to equal credits, so you can just kind of do it that way, pretty easy. And we'll just say record supplies used in November. And again, when these X's go away, there's no right answer for the explanations. It's just, that part of it is just asking you to put something in that section. So might as well put something that makes a little bit of sense. Okay, on part B, we borrowed $1,440 and issued a 9% 3-year note with interest payable annually and principal due at maturity. Okay, so the first thing that we want to record, right, we took out cash and we have notes payable. So this is like our initial receipt of this cash. So 1440, and we can say, bank loan proceeds. Okie doke. All right, now we're going to go down and say, let's record our adjusting entry at the end of December. So December 1, we took the amount, we borrowed the cash. Now, at the end of December, we need to record the portion of interest payable that we have accrued, right? So how we're going to do that is we're going to say the total balance of $1,440 times 9%, and I get that equaling, let me see here, $129.60 per year, annually. So 9% times 1,440 is $129.60 of interest expense per year. That's the cost to borrow this money. It's a 3-year note. Okay, so and then we can let's divide that by 12. to get $10.80 per month, right? So interest expense per year is $129.60, taking 1440 times 9%, and then divide that amount by 12 to get monthly, and that gets us $10.80. And here I'll do it like this just to show, so maybe this is helpful too. So I'll put a formula in so you all can see. So we're going to take 1440, so that's our F23 cell, times 9%. Okay, and that gets us 129.6, and then it gives us a little answer there. So then the next step, let's divide that whole thing by 12. You have to put parentheses so it does the multiplication first and then the division, and then you end up with the right answer. So again, you can see the formula up there that we're using. And we're going to record interest expense for that, because that is the portion of interest that the expense that we incurred in December, because we had the money, we borrowed it that whole time. So, sorry, interest expense is what I want. And interest payable is the related liability that's going to increase as we now, owe this money. Accrued December interest, let's just say that. Okay. On July 1st, so here we are with a prepaid transaction. So now we're going to be paying prepaid insurance. And this is our purchase of the prepaid insurance. Day one, we have, this is us just purchasing insurance, not using it really yet. Now, the whole thing of, using quote unquote the insurance is just us being covered by the policy over time. So now at the end of that month of having the insurance policy, 1 month of it is gone. We only have 2 months left. So we need to adjust the balance of 540 down, because that represents 3 months initially. Now we need it to be 2/3 of whatever that balance was, essentially, to represent that we have 2 months remaining. Right. So let's go to prepaid insurance. We're going to reduce our asset. And I'm just going to do a divide by, let's do a formula here. Let's do it like this. 540 divided by 3, right? That would give us each month, because it's 3 months. And then that's all we need, I guess, for this one, because really we're just reducing by 1 month. So now there's 180 times 2, was that 360? So 360 would be our balance of prepaid insurance after we reduce it. And that represents 2 months of additional coverage we have for, in this example, August and September. So insurance expense for July. Let's put that in. Okay. On 2/1, we received $450 in advance from a client. And so we're going to say we haven't done this work. I mean, that's what we're assuming here. It's unearned revenue type of situation. And so we're going to record the fact that we got the cash, but it's not our cash yet. We're just holding it for the client, if you want to think of it that way. We'll just call it client co-deposit. We'll just say that. And then on 2/28, 1/5 of this has been earned now. So we have, the full amount is not ours yet, but we've done 1/5 of the work for it. So we will record 1/5 of it to be ours. And so we want to reduce our unearned revenue by 1/5. And we want to increase our actual revenue to show that we actually earned it during this month. If I can find the service revenue, let's just do that. And we'll just say revenue earned. Okay. Okay, on 8/1, we bought a piece of equipment for $1,296. So we're going to buy equipment, and we bought it on account. So I think we're going to use accounts payable. Yep, $1296. Equipment purchase, per se. Okay, and now we're going to record a depreciation expense entry here on for 1 month of depreciation expense on the 8/31. So let's go to depreciation expense and accumulated depreciation equipment. And we'll just say, I'm just going to put this in just to do it, August. Okay, so the formula we're going to use, and remember for depreciation, is basically just taking the amount historical cost divided by the life, and we just want 1 month's worth, so we're going to divide by the life in months because we just want 1 month in this. We don't want years. We could divide by 10 if it was years to give us a whole annual, but we just want the 1 month, so we need to divide by 120 months, which is the same thing as 10 years, right? So we're going to say 1296, but there's one little wrinkle. We take historical cost, and if it has a salvage value or residual value, then we subtract that. So we take our original cost, 1296 minus 64.8, and then divided by 120 months. So that, again, that's what the formula here shows. Okay, here we paid $810 for 4 months of rent. So this is, again, a prepaid kind of a deal. So we paid this is our original purchase. So right when we pay for the 4 months, it's $810 prepaid rent. And I'm going to put 4 months. This is the kind of important stuff you would actually want to know when you go back for a journal entry. So an explanation like this would actually be helpful, because if you're doing actual accounting work, without seeing the invoice or the contract, it's nice to just have this in the explanation, because you wouldn't have this. This is like a school, explanation to you all to calculate. But having 4 months allows you as the accountant later to go back and, I know we paid $810. How many months was that for? 4 months. Okay, now I can figure out how much it is per month in rent expense. So that's what we're going to now record, is the 1 month is now gone. One of the 4 months is over, March. And so we want to adjust this 810, which represents 4 months, down to just 3 months. And so we want to record rent expense, and we want to reduce the prepaid rent by 1/4. So we'll just take that number, divide it by 4, and we'll say, and that the amortization of rent. So amortization is the term for when you reduce an asset in that manner. So I'm just going to use that terminology, so maybe you all become a little bit more familiar with that, if you might hear me use that in different contexts. So okay, and another way to say that is spreading the cost of this prepaid prepaid rent expense asset over its lifespan. If you want to think of the prepaid rent in terms of a lifespan, because it only lives for 4 months, let's say. Okay, a few more problems here. On 4/1, we borrowed $1,800 and issued a 10-year 12% note with interest due annually. Okay, and so we got cash and we got a liability, so we have a note payable now. So remember, if we turned around, had second thoughts on borrowing this money, we could just walk back into the bank. We were holding $1,800 of cash and hand it back to them, and this would just zero out. But that's not what we're going to do here. But just remember that sort of movement, in terms of the accounting equation: assets up, liabilities up. Okay, so note proceeds, and in this instance, a good explanation would be 10 years, 12%. This would be important stuff to know in the real world for calculating later adjustments, right? And so if we're at the end of this 1 month, we're going to want to record some interest, because we now had this cash for 30 days, 1 month. Usually we just do it by month when we're looking at monthly transactions. So you can divide by 12 as opposed to actually divide by 365 days times 30 days, times the individual days in the month. But for our purposes, if we're just looking at 1 month at a time, we're just going to take the 1,800. I'm going to do let me do a little. So I'm here in my formula. Let me do a parentheses. So we have 1,800 times 12%. divided by 12, right? Because it's 12% per year. $1,800 is our principal outstanding, and we want to know how much each month, so 12 months, that's going to be costing us. We'll just say 1 month interest expense. Okay, now we've got another depreciation entry. So now we bought some equipment. So we're going to increase our asset for the equipment, and we bought it on. We buy it. Oh no, we paid with a check, so cash. $12.96, and we'll say I'm going to put 6-year life SV 194.4. So this would be salvage value. So that, again, I'm just trying to do this a little bit more like what would actually be useful to know as an accountant later in your explanation would be stuff like this. So when you go back, you can do your journal entry for depreciation, and you have the information that you need to do that calculation in the explanation of the original entry. Okay, and so now you go, let's do our formula again. So remember, it's a historical cost minus the salvage value divided by the life. And again, we just want 1 month, not 1 year. So it's 6 years. So how many months is that? 72, right? And I'll even do it in here. It'd be 6 years times 12 months per year. So that would be, I think that's 72. Yeah. So again, that formula, original cost, $12.96 minus the salvage value or residual value. Sometimes you'll see it said that way, divided by the years. But we want to know how many divided. This is really divided by the months. So it's 6 months times 12. 6 years times 12 months per year. And then we use the accumulated depreciation contra account. And jump me up top. Good to go. And we'll say, what month is this? October depreciation expense. Perfect. Okay, this is great. I really spend some time on this. Like, try to soak this in. This is important for doing your adjusting entries and understanding how these all work. So, really, I like this problem a lot. Okay, and then let's. Okay, on to number 6. So I think I'm going to skip over this problem, and I'm going to let you all just refer back to number 4, because this is going to be basically the exact same process. So give that a shot and follow my kind of same process and thoughts and all that on here, and let me know if you have any questions. Okay. I think on this one as well, you should be able to just refer back to problem 5. You'll see a lot of similarities here. I'll just look through these real quick and see if there's anything that stands out to me. So on this problem, it's going to be an unearned revenue type of transaction. So we received cash and recorded an unearned revenue liability. And then we so it's 3 months that we're going to perform the work. So we're going to record 1/3 of the $810 in unearned revenue deposit over those months. So September would be 1/3, so 810 divided by 3. Unearned revenue will decrease and revenue will increase. In this problem, we purchased office supplies. So on account, so accounts payable, and we'll record an asset of office supplies increase, $270. And then we need to take the difference between the remaining amount of $81 and record that as a reduction to the original total. So 270, whatever 270 minus 81 is, that's the amount that's been used up in April. And we need to reduce the office supplies asset and record supplies expense for the portion used. In C, we paid a deposit for 6 months. So 1080 represents 6 months of prepaid rent. So we're going to, that's cash going down and prepaid rent asset going up. And then if we are, what is this one? Okay, so here we're doing an adjustment at 12/31, which is, how many months is that? We have September, October, November. So that's 4 months has been used up by the time we get to 12/31. Does that make sense? So we started in September 1st. So September So this 6 months is September, represents September, October, November, December, January. So it's through February. That would be 6 months, including September, because we paid on the 1st. So at 12/31, we've used 4 months of that up. So you can take your 1080 divided by 6 will give you a monthly amount of rent, and then multiply that by 4 to represent that we've used 4 months up, and reduce the expense, the prepaid rent expense, by that amount, 4 months of whatever that rent is, and then record 4 months of rent expense the same way. And just because, I'll do this one with you all real quick, just because this is a little bit maybe different than any one you saw in the first part. So let me just make sure you understand. Prepaid rent, well, we'll say 6 months, and we'll even put the date September through February. And then again, so what we want to do here is this is our first adjustment to, we have not been doing this monthly like we were looking at previously. So we're going to make the 1 annual reduction to prepaid rent to reduce it to its actual value. And we'll say 4 months rent expense. And so here's what I was saying is, we're going to take our total, which represents 6 months. We're going to divide that by 6 to get a monthly amount. And then we're going to times that by 4 to represent that 4 months of this contract have been used up. We have 2 months left. So 720 minus 1080 is the total of the residual portion that would represent 2 months left on the contract. Okay, and letter D, it's another depreciation entry. All right, I'll do this one with you too, because it's a little different. This one is again asking us on account. So this is our initial purchase. Now, again, we bought this on 5/1, so May 1st. So now we're going to look at May. How many months is that? So how many months is that not? So the amount of months that is not represented here, right, would be January, February, March, and April. We didn't have the equipment then. So that's 4 months. So then from May through December, which is 8 months, we did have it. So we're going to do our journal entry for depreciation expense, which is the same expense and then accumulated depreciation. Let's do our formula to calculate that. So we take the cost minus the salvage value. Now that's 4 years. We want months. Again, remember, because we're going to record 8 months of depreciation expense on December 31st. So we are going to divide by 4 times 12. That's the full amount of months. So that would be what, 28? And that gets us 67.5, which would be each month. And then I'm going to do one more parentheses around the whole thing, because this is that was monthly depreciation. And we want to record 8 months of depreciation, because we're recording all the depreciation from when we purchased it up until the end of December. And we know that we haven't done any of these kind of entries yet, because it tells us right here that we have not yet done any entries, no adjustments. And we'll just say 8 months depreciation expense. Typically, you would do this every month, but we're just giving you some examples of how to kind of play around with this differently. Okay, so again, let me work through a few of these, because they are just in case anybody's getting a little hung up. For the ones where we're looking at multiple months or portions of a year, it's probably good to do this together. So here we are, just loan proceeds, 7-year, 6%, we will say. So we got $9,000 in cash, and we owe $9,000 to the bank now. Now we're going to, again, do our adjusting entry at 12/31. So on this, we took it out on March 1st. So now there's only 2 months we didn't have it. So we've had this loan out for 10 months in December, in this year that we're looking at. And we're at the end of the year now. We haven't done any previous adjustments. So we need to record 10 months of interest expense if I can find interest expense. Not the credit version. There we go. And 10 months of interest payable that we owe. Now that we're at the end of the year, we took it out on March 1st. So March, including March all the way to the end of the year is 10 months. So our formula for that is going to be the 9,000 times 6% or 0.06, right? If you want to do it with a decimal. And then we're going to say that would be our annual. So let's divide that whole thing by 12 to give us a monthly interest expense portion. So this is annual. Dividing by 12 gets us a monthly amount. And then again, let's put parentheses around the whole thing because this is representing monthly interest expense, and multiply that by 10 months to give us the total. So it looks like $45 per month times 10 months gets $450. 10 months interest expense, we'll say. Okay, here we are with prepaid insurance. So we paid, what do we got? $432. So this is us just at the outset paying for the contract. And let's say prepaid insurance, 1 year. Okay, so that was October 1st. So this is 12 months, obviously 1 year, right? And now we are, and that's October's October, November, December. So 3 months have been used up, assuming no previous entry adjustments. So we need to record 3 months of insurance expense and reduce our prepaid insurance asset balance down by 3 months, basically, right? So let's take our total, divide that by 12 to give us a per month amount, and then just times that by 3. And so 3 months used up, and then 9 months remain. 3 months insurance expense. Okie dokie, let's see. Okay, so this one we bought some equipment again. It says a check, so let's use cash. So let's do our formula: $7,200 minus an $1,800 salvage value divided by how many months? Let's see, 5 years times 12, so that's 60. So per month, our depreciation expense would be $90, right? This is dividing by 60 months life. And then we want to record how many months? A 2-1, so 11 months. February, just January was the only year we didn't have this thing. So in this year, we had 11 months worth of depreciation expense. So I'm going to put extra parentheses there and then multiply by 11. And then keep in mind in the next year, it would be a full 12 months because we would have had the equipment the whole time there. So I'll say 11 months depreciation expense. And, oh wait, so maybe I did something wrong. What am I missing here? Something didn't work right. Oh, I'm sorry. February, no, that was, is this just the purchase? I screwed that up. Let's take that same formula and put this down here. Sorry, that's supposed to be just the purchase of the purchase of the equipment, not the depreciation expense portion. I got a little ahead of myself there. Okay, so then let's just put our depreciation expense, accumulated depreciation, and copy our explanation over. And here, this is just us buying the equipment. So that's all good. Okay. On 11/1, Grandpa Company borrowed $5,400. So again, hope you all are getting a little more comfortable with. We got cash, we got notes payable. Let's say 5-year note, 8%. Handy stuff there. $5,400 is in our bank account now, and we owe $5,400 back to the bank. And this was November 1st, so we have 2 months to record between taking this out and the end of the year here. And that's going to be our interest expense and interest payable. and we'll say 2 months interest expense. And so to complete this, we're going to take our $5,400 total principal times 0.08 or 8%. And that would give us, remember, our annual amount of interest expense, but we want to do just 2 months, right? Because we had November and December. So I'm going to say 2 divided by 12 instead of just dividing by 12, because it's 2/12 that we're recording. Oh, what did I do wrong? Times oh, that should be times 2/12. Do my math right there. Oh, and not insurance expense, interest expense. That shoots you up to the top. That's weird. Okay, so all good. Yeah, so the supplies one, very similar, to the previous explanation there, and this shouldn't be too difficult, I don't think. Yeah, 1 month's worth of work, so one third of that will be recognized in. So I'll let you all work on that problem yourselves, and yeah, let's look at this problem here. Okay, so now we're going to be doing some financial statements, and remember, this is with the classified balance sheet and all that. It's got the current and the long-term assets, right? Not just assets and liabilities like we had, before, that we've looked at previously. We're actually going to break out current versus long-term. The income statement is going to look basically the same here. We've got we need some revenue to record. Where's our revenue count? Oh, it's consulting revenue. There we go. And it was 1710. So just, we've got all our balances up here. And then our expenses, we've got depreciation expense. I'm just going to go down the line. Then we've got, what's our next type? Rent expense, I think. And then, and finally, we've got supplies expense. And we've got 90, and I see 720, and supplies expense of 90 as well. No, that's not, sorry. That was supplies, not supplies expense. There we go. And then let's do a formula to just add all of these to get total expenses. And then take our revenues minus expenses to get our net income. Okay, we're good there. Now we want to work on our retained earnings statement. So we want to take our beginning balance of retained earnings. So at the beginning of the month, 1/1, or you could also say, more commonly what you would see is, 12. Yeah, so this is one whole year. So 1/1 would be January, 1st, 12/31 is the end of the year. And like I said, more commonly what you see instead of 1/1, it means the same thing basically, would be 12/31 of the previous year versus 12/31 of the current year. And let me put that in the right spot. That's supposed to go there. This is going to be plus our net income from above. And our beginning balance of retained earnings was 765. And it looks like we probably had some dividends in here. Here we go. And that was 270. And so if we take beginning plus revenues minus expenses minus dividends, we end up with a ending retained earnings balance of that. And keep in mind, this is the same thing that we do on the closing entries. We're just showing it in a report format, right? We have beginning retained earnings, and then we're closing the net income, and we're closing the dividends. If you want to think of it that way, we're adjusting retained earnings by doing that, aggregation or summation into it, or closing, if you will. And then the journal entries are how we actually do that from a debit and credit perspective in the ledger with the account balances, etc. Okay, let's look at current assets. So it's always cash first, most liquid. Usually we have some AR. Do we have prepaid expenses? We probably do. Yeah, we have prepaid rent and maybe some supplies. Yeah, we got supplies. So that's all our current assets. All the non-current stuff is going to be things that are, plant assets. So that's going to be like equipment and buildings. So I think building will be our first one. Do we have any equipment? Yeah, we have equipment, and maybe we have land. Oh, but it's held for speculation. It's not a planned asset, right? That. So let's see, what other franchise? Would franchise fall under that? Let's give that a shot. No, that's going to be an intangible asset. Sorry. So let's go ahead and put that down, because it's not as intangible as like something you can't, hold on to. It's not a physical asset essentially. So what is our other? So we have building. Oh, the other intangible asset then would be our copyright. So let's go ahead and throw those in. 90. What's our copyright? What is 360? So our total intangible assets then is 450. The long-term investments that we have is just land, and we know it's held speculation, spelled that wrong, but 450. So that's here. And the way we know it's an investment is because it says held for speculation. If it was just land, it would more so fall under some type of, plant asset or plant property, PP&E, plant property and equipment. So, what are we missing here, though? We've got building, equipment, and no payable, prepaid rent expense, supplies. What are we missing? I'm going to put these in. Oh, you know what? Okay. I think what they are getting at is building and equipment. Sorry, just finding my totals. So these are the only two plant assets, but I think what we want to put in down here then is our accumulated depreciation for the building. And once the equipment has some depreciation, let's put a negative on that because it is a minus. I think that's going to be the answer. So remember that this is a contra asset, accumulated depreciation. Once equipment has some accumulated depreciation, this tells us that we've never depreciated this equipment yet. Maybe we just purchased it. That we would have accumulated depreciation for both. So there we go. And then let's put in our cash, accounts receivable 270, prepaid rent 225, supplies of 90. Okay, let's add together all these amounts. There we go. Now let's add all our totals up for assets, and we got our assets. Okay, let's look at our liabilities now. So AP is usually always the first one, and liabilities most soon to be paid, if you want to think of it that way. Unearned revenue is another common current liability. Let's put that in, and we've got our unearned revenue portion is 360. Boom, add those together. Okay, our long-term liabilities. Let's see, our note payable, which is due in 08, and we're at 01 or whatever this, it's 7 years later it's due. So that's going to be long-term because it's past. Oh wait, is there a current portion? Why did that not? Did that work? Let's see if this comes out. Oh, sorry. There's two X's. I didn't see that one go away. Okay, so then we've got total liabilities. We're just going to add those together. And then we've got, remember, common stock and retained earnings is going to be in our shareholders' equity section. Ending balance of retained earnings, remember. So common stock we have as 720. And then that's from our listing, but the retained earnings portion is going to come off of our retained earnings statement here. So that is the total there. I just linked that in there, so it's just pulling in. Keeps moving around when I hit enter. Okay, and then let's add these together, get our total shareholders equity, and then add our liabilities and shareholders equity. And yep, the X goes away, and we can also check ourselves because total assets is equal to total liabilities and equity. So we're looking good. Okay, so yeah, a little bit of extra work, for those kind of financial statements, and I will leave this one for you all to complete. And let me think if there's anything, though, if there is anything kind of a little different on this one. In this one, we have to differentiate between the bond payable and the note payable. And the note payable is due during boom, 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 note payable due 8101, and this is the timing's kind of weird on that, but I think what they're trying to get out here is this is 7 years later. This is going to be current, I think. So let's give that a try. Yeah, so even though it's a note payable, if it's going to be due within the next 12 months, it will still be current. And then if we have this bond payable, which is due farther out, then it's going to be the long-term portion. And then let's see if there's anything else kind of different here. Notes receivable, we would have as maybe it's current. Notes receivable, it's more of a long-term. So I think on this one, we would consider that our investment. And we notes payable is a long-term debt that we've incurred, but a notes receivable, if we're lending money over a long-term period, right, that would fall in there. We've got things like trademarks, and what's the other one? A patent. Those are intangible assets that we could have. Then the plant assets, remember, are things like machine. Well, not net income. Sorry. Click there. Machinery. Maybe land. I think falls in. Yeah. So the other land was in land held for speculation. This is just land used, in operations. And then we have some accumulated depreciation we want to account for. Remember that shows as negative. Land is never depreciated, so keep that in mind. It will never have a depreciation expense or accumulated depreciation associated with it. Current assets, similar type of stuff, AR, prepaids. Trying to think what else might fall. Cash. Cash is number one, right? AR. And then what's the other one? Let's see, what do we got? Cash. Inventory, the common one there. I'll fill out the rest, just pulling those in. Nothing too fun, interesting there. Remember that when you're doing your retained earnings, that you make sure you pull in the beginning and then you have the ending in the right spots. And you make sure you're pulling your ending down here on retained earnings, not the beginning balance. And I think you all can handle the rest of this, so I'll leave you to it. Okie dokie. So here's a few more adjusting entries, and let's just go through these quickly. This is kind of freezing in the wrong spot for the Excel part there. Let me see if I can fix that. I don't even know if that fixed it, but anyway. Let me take a look here, and then we'll just post our adjusting entries. Okay, so we bought $500 on July 15th. At the end of the year, just $280 remain. So we just have to take the difference between those, and we'll record supplies expense. And the expense portion that we used up, and then we'll reduce our actual supplies account. And we can do a formula and make this a little easier. 500 minus 280, that remains. And we get 220 used up. Okay, we received $3,500 in advance for work that we will perform evenly from November 1st to March 31st. So originally we recorded under revenue, and it's how many months? So I guess let's just do some formula. You can use Excel here to answer all these questions for us. So 3,500 represents November, December, January, February, March. So 5 months. So 3,500 divided by 5, basically. But we've times that would be per month, but we performed, this is recording in December, and we started in November. So we had November and December to record. So that would be 1,400. And we would be reducing our liability for unearned revenue and recording service revenue, basically. Wait, what did I do there? Oh, I picked the wrong service revenue. Yeah. Okay. And then we paid, $840 on 9/30 for 12 months insurance in advance. So we paid at the end of September, so that doesn't count. But we've got October, November, December, so 3 months used up. So we're going to do insurance expense. We're going to reduce prepaid insurance. Let's do our formulas here. So we've got 840 representing 12 months. So divided by 12 would be per month. But here we've got 3 months used, basically by, October, November, December, by the end of December 31st. Okay, so we want some, I would say adjust for equipment depreciation, but expired. Okay. So let's go through and do our depreciation expense. It's always, we've got accumulated depreciation as our contra asset, our credit. And let's do our formulas here. So we have a $17,100 piece of equipment. Subtract the salvage value, divide by, I'm going to go 60. So that's 5 times 12, 60 months. So that would be per month, this amount here, 280. And then how many months do we have though? We have purchased it on 4/1. So we have 9 months, right? So April through December. We did not have it in January, February, March, or we purchased it on April 1st. Okay, the next one, we borrowed some money and we are going to record some interest expense here. So let's just get our accounts first. Interest payable. Now, how much is it? So let's do our calculations. So we borrowed $14,000 and it's 9%. Oops, times 9%. Let's just, times 9%. Put that in. So annually, it would be $1,260 of interest expense. But we only need how many months? We need. We took this out on the end of July, so we're going to start in August. So we have August, September, October, November, December. So 6 months. So I'm going to multiply that by 6/12, basically, or 6. Is that right? Did I do my months right? Wait, I think it's, is it 5 months? Yeah, sorry, 5 months. We had August, September, October, November, December. Yeah, that's 5 months. Okay, so the annual, and then you could divide by 12, which would give you per month, and then multiply by 5, but you could also just do it in one, formula that way, 5/12. Okay, paid 3 months rent in advance of $12,600 on 11/1. So 2/3 of that is gone, right? We stayed there in November and December. We paid the money initially. So now we're going to record rent expense for those 2 months. We're going to reduce prepaid rent. And we can do our formula as 12,600 divided by 3. I'm going to say times 2/3, right? Or we could say divided by 3 times 2. That's the same thing. And then that, if we did it by 1, it's $4,200. Basically, what we're saying is $4,200 of rent is how much it costs per month. Times that by 3 gets us 12,600. And then taking that 4,200 times 2 gets us 8,400 used up because we stayed there for 2 months by the time we're doing this adjustment. And remember that we are assuming no adjusting entries have been made yet, right? Usually we do this on a monthly basis, but in this problem, you got to figure in like how many months have actually been in the year where this is applicable. So cool. And then last little piece, I'll help out here. So we just have to go through and do some analysis. So remember, our current assets are things like cash, AR. Remember that I'll do it with you just for the heck of it. So 450 for cash, 315 for AR. What else do we got? Inventory is a current asset, and prepaid expenses and supplies. Okay, and then current liabilities. This is the one that's maybe a little bit, makes you think. So this one is 9 years out from, or 8 years out or whatever. So it's not current, it's long term. The note payable is due the following year, right? So this is 12/31 we're thinking about, and this is due on September 1st of the next year. So it is current, even though it's a note payable. AP is always current liability. Unearned revenue is a current liability. Wages payable is a current liability. And I think that's, I must have, fixed my formula there. Okay, that's everything there. And then the current ratio is really easy. It's just assets divided by liabilities. We are, how do we compare? So the higher the number is, would represent having, let's see, if we have current assets over current liabilities, then you are going to want to have a bigger ending, metric essentially, right? So if we're at 1.25, I think we are riskier then, right? Because if we had more current assets, we would increase our ratio to get closer to 2. So we have a lot of liabilities, not as many. I mean, we have enough to pay our bills off, but in the average is 2. We're not in line with the average, basically. So I'll let you all do the rest of these. No, I'll do it. I'll just help you out. I'm feeling generous. So net income, remember, is revenue minus expenses. So this just gave us all the expenses together. Let's say we've got, so profit margin then is going to be our net income divided by let's think about that. So our net, I have to actually think about this. We know our net income is net income divided by net sales revenue, right? So that will equal our sales minus our cost of goods sold. So the things that we had to pay to buy the stuff that we're selling, right, essentially. And then we're saying out of that $1,125 of profit, or gross profit we made from selling our items, again, our price customers paid us minus the amount we paid to get those things in the first place to be able to sell them. Then we divide, so that's our 1125. And then basically what this says is, how much of that 1125 do we get to actually keep as profit after we account for all the rest of the expenses of running the business? And it was $225 after accounting for other expenses. So 20% of the total net sales we got to keep as profit, basically. And we are doing better than the average 15%, right? We're keeping 20% instead of the average of 15%. So pretty cool. All right. Well, thanks, everybody. Hopefully this is helpful, and I'll see you all in class. Have a great day.